Is the housing market starting to fall apart? Sadly, yes. But is it going to be 2008 all over again? Well, it's a little more complicated than that. In 2008, housing prices dropped so much that homeowners found themselves owing more than their house was worth. So a great deal of homeowners just walked away from their homes, essentially passing ownership of their house to the mortgage holder or bank. But today we live in a little bit different time. Nearly half of all homeowners would be considered today equity rich. That means that they have enough equity in their home and they're paying such low interest rates that if the housing prices drop, they are far less likely to walk away from their home or hand it to the bank. Instead, the real danger are the office buildings that have been sitting empty for years now. Since the office building occupancy rates never fully recovered after people started working from home during COVID, office buildings are now worth actually 40% less than they were worth prior to the pandemic. And although the banks know that office buildings have lost a huge amount of their value over the last few years, they just keep rolling the commercial property loans over, hoping that workers would eventually return to the office. Well, it's 2026 and the game's over. In January alone, the loan delinquencies at office buildings hit a record 12%. That's higher than at the peak of the 2008 financial crisis. Yes, the banks are finally starting to realize their office building losses. Unfortunately, it's hitting the regional banks the hardest. Why? Because the regional banks hold the largest share of these mortgages, about $1.8 trillion in total. As these commercial properties start going into default, it eats into the bank's capital. And remember those unpaid FHA home loans we talked about in part 1? Well, when you combine empty office buildings that can't pay their bills with a huge wave of people who are losing their homes, banks get scared and stop lending to businesses. And when banks stop lending money, small businesses can't grow, people can't get mortgages, and the economy stalls. And the Fed is worried about this as well. In fact, they just conducted stress tests on 32 major banks because they're so concerned that these banks won't be able to weather the coming commercial real estate crisis. I hope you'll stay for part 3. Here we'll talk about how we can protect our wealth as these cracks in the housing and banking systems begin to widen.